You know those true crime documentaries where the camera slowly pans across a dimly lit room and there's this massive corkboard on the wall?
Oh yeah, covered in the red string.
Exactly, the red string. It's just completely covered in like photographs, maps, financial records, and there's this intricate, chaotic web connecting everything together. I mean, it looks like absolute madness to anyone walking in off the street.
But to the detective staring at it, it's a meticulously constructed map of reality. Every single piece of string represents a hidden connection. A transfer of capital across borders, a sudden movement in the labor market, a timeline of technological breakthroughs. It's basically the visual representation of trying to find a clear signal in a sea of overwhelming noise.
And when you look at the artificial intelligence landscape today, especially sitting here in 2026, it feels exactly like staring at that chaotic corkboard. For you listening right now, just think about your daily news feed. You get whiplash.
Oh, absolutely.
One headline tells you $1 trillion just evaporated from the stock market because of a new algorithm. The next one says a new chatbot is going to cure cancer. Then you read that your entire department is going to be replaced by digital agents, followed immediately by, an article claiming AI is going to make us all more productive and wealthier than ever before.
Right. It is a relentless flood of contradictory information.
Exactly. But the question that actually matters to you is, where is all this money physically landing? And how is it tangibly, like irreversibly changing the reality on the ground for your career, your business, and your daily life?
Well, it's incredibly easy to get blinded by the sheer velocity of that news cycle. I mean, the human brain isn't really wired to process macroeconomic shifts that happen in a matter of months rather than decades.
Hmm.
You see a headline about a venture capital mega round, but without the underlying context, it's just, a big number floating in a vacuum. It doesn't tell you what the market is actually valuing, or more importantly, what the market is preparing to discard.
So today, we are playing the role of that detective. We're taking a forensic deep dive into the source material specifically, the newly released 2026 Stanford AI Index report. And this isn't, a quick skim.
No, definitely not.
We are putting our magnifying glass squarely on the economy, labor, and investment sections of this massive 400-page document. Our mission is to cut through the marketing hype of the tech companies and the panic of the media. We want to identify the true, undeniable signal within global AI spending, employment shifts, and adoption rates.
Because understanding this influx of capital isn't just about trying to pick the right stocks on Wall Street. It's about understanding the new rules of the global economy before they run you over.
Right. And the Stanford AI Index is effectively the gold standard for this kind of rigorous macroeconomic tracking, isn't it?
It is. They aren't relying on press releases. They synthesize hard data from places like Quid, LinkedIn, Lightcast, McKinsey, and when you take all those disparate data streams, pin them to our corkboard, and start drawing the red string between them, a very specific and frankly somewhat sobering picture of the near future begins to emerge.
Well, we have to start our investigation at the beginning, and that means following the money. So to understand what is happening to the labor market and how businesses are actually using this technology, we first have to map the sheer scale of the capital fueling the AI ecosystem right now. We hear about big funding rounds all the time, but the numbers in this report feel completely decoupled from traditional economic reality.
Yeah, they are operating on a scale that is genuinely difficult to comprehend without historical context. So the report tracks a metric called global corporate AI investment, which is a massive umbrella. It encompasses mergers, acquisitions, minority stakes, and private investments. In 2025 alone, that total global corporate investment more than doubled from the previous year, reaching a staggering $581.69 billion.
Wait, let me just pause there so you can fully digest that number. Over $500 billion
Yeah.
in a single 12-month period. I
Yeah.
mean, that is larger than the entire gross domestic product of countries like Austria or Singapore. That is an astonishing amount of capital moving into one specific technology sector. Where's it all coming from?
Well, if we isolate just the private investment piece, meaning venture capital and private equity flowing directly into startups and established private firms, that number hit $344.66 billion.
Yeah.
That represents an increase of 127.5% year over year.
Wow.
Right. So this indicates that while big publicly traded tech companies are doing their fair share of acquiring, the appetite for funding brand new and rapidly scaling private ventures is absolutely ravenous. Investors are desperately trying to get in on the ground floor of whatever comes next.
I have to wonder about the breakdown of that money, though. Because AI is a massive catch-all term. It can mean, predictive algorithms that decide what ad to show me on social media, or machine learning models that predict crop yields for farmers. Is this just a general rising tide lifting all of those various AI boats, or is there a specific type of technology pulling all this cash into its orbit?
It's definitely a very specific engine driving this train. Generative AI is the undisputed catalyst here.
Okay,
Out of that $344 billion in private investment, generative AI companies captured $170.87 billion.
almost half.
Exactly. That is a growth rate of over 200% from the previous year. Generative AI now makes up nearly half of all private AI funding on the planet.
So it's not the background algorithms we've had for the last decade. It is specifically the systems that generate net new text, video, audio, and code. The models that can write a legal brief or generate a photorealistic video from a text prompt. That is where the gravitational pull is strongest.
Spot on.
Let's talk about the geography of that gravity then. Where on the globe is this money physically concentrating? Because we always hear about this being an arms race between the U.S. and China.
The geographic concentration is incredibly stark on paper. The United States completely dominates the private investment landscape. In 2025, the U.S. recorded $285.88 billion in private AI investment. To give you a sense of scale, that is 23 times greater than the private investment mapped in China, which sat at just $12.41 billion.
Wait, 23 to 1?
Yeah, 23 times.
If the U.S. is outspending China by that kind of multiple in private markets, that doesn't sound like an arms race. That sounds like a complete and total blowout. Is China just entirely missing the boat on generative AI?
See, that's where we have to be incredibly careful not to misinterpret the limits of this specific data point. That 23 to 1 ratio only tracks private market investment, your traditional venture capitalists, private equity firms, angel investors. That metric fundamentally understates China's total AI capacity because of how their macroeconomic system is structured.
Right, because the state is involved.
Exactly. The Stanford report points out a critical nuance here. China utilizes massive state-backed vehicles known as government guidance funds. Between 2000 and 2023, those state funds deployed an estimated $184 billion directly into Chinese AI firms.
Wow.
And to accelerate their position recently, China announced a new $130 billion state VC fund explicitly designed to invest in cutting-edge technologies, with AI at the absolute center.
Okay, well, that changes the picture completely. The American money is happening out in the open, highly publicized on Sand Hill Road in Silicon Valley, with VCs tweeting about their investments. But the Chinese money is flowing quietly through state-directed sovereign channels that simply don't trigger the alerts on a standard venture capital tracking database.
Yeah, the red string on our corkboard just crossed international borders in a very opaque way.
Right.
And even within the transparent U.S. private market, the fundamental behavior of capital is mutating. It's not just that there is a larger volume of money, it's that the money is clumping together into these massive, supermassive financial anomalies. The average private deal size ballooned by 46% to $66.52 million per deal.
Per deal.
Per deal. And even more telling, the number of billion-dollar funding events where a company takes in over $1 billion in a single round of funding nearly doubled, going from 15 events to 28.
Let's contextualize that for the listener. Just 5 or 10 years ago, $1 billion was the valuation of a rare unicorn startup. Reaching $1 billion valuation meant you had arrived. Now, $1 billion isn't the valuation. It's just the check they're cashing on a Tuesday afternoon to keep the lights on.
Yeah, the valuations attached to those checks are staggering. We saw OpenAI raise a monumental $40 billion at a $300 billion valuation.
Unbelievable.
We saw AnySphere, the company behind the popular AI coding assistant Cursor, raised $2.3 billion at a $29.3 billion valuation. I mean, these figures completely defy traditional software as a service economic models. In traditional software, you build an app once, and the cost to distribute it to 10 users or 10 million users is practically zero. AI doesn't work like that.
Right, let's pull on that thread because I think it's the most important question of this entire section. Where is all that cash physically going? If I start a traditional software company and raise $10 million, I'm spending that on hiring a bunch of programmers and maybe a marketing team. But you can't just pay 1,000 software engineers $40 million each. What are these AI companies actually buying with hundreds of billions of dollars?
They are buying the physical foundation of the internet. The data shows that the foundational layers of the ecosystem are absorbing almost all the cash. Categories like AI infrastructure, base models, research and governance attracted $143.22 billion of that private funding.
Foundational layers.
Exactly. But to truly understand the scale, you have to look beyond the startups and look at the hyperscalers, the massive cloud providers like Amazon, Microsoft, and Google. They are spending unprecedented amounts on capital expenditures known as CapEx. Google alone reported over $150 billion in capital expenditures for 2025.
Okay, when you say capital expenditures, we need to be clear about what that means in the real world. That isn't software. That is concrete. That is steel. That is securing massive plots of land near major water sources. They are buying hundreds of thousands of specialized silicon chips from NVIDIA. They are building colossal football field-sized data centers, and they're literally securing their own power grids to keep them running.
Yep. And that infrastructure build-out is exactly why traditional software economics are breaking down. The compute costs to train a frontier model, the electricity, the cooling, the server degradation are astronomical.
Let me try a historical analogy here to see if this frames it correctly. Think about the massive railroad boom in the 19th century. Back then, you had hundreds of speculative companies promising to build the fastest, most luxurious train lines across the American West. Billions of dollars flowed in. Eventually, many of those specific train companies went bust because it was a massive financial bubble. But the real enduring economic value, the permanent shift in the economy, was created by the companies laying the literal steel tracks, the companies securing the real estate, the companies forging the iron and mining the coal. Are we seeing a dynamic today where the train companies, the thousands of AI apps and specialized chatbots might be in a bubble, while the real underlying value is in the companies laying the steel tracks, meaning the infrastructure, the chips, and the data centers?
It's an incredibly powerful historical comparison, honestly, because the market is currently experiencing violent mood swings regarding that exact tension. The infrastructure companies, the ones making the chips and building the data center, seem like the safest bet. But even the steel tracks aren't immune to technological disruption. The report highlights a fascinating event in early 2025 involving a Chinese model called DeepSeek R1.
Oh, I remember this. What exactly happened with DeepSeek?
Well, DeepSeek utilized a highly efficient reinforcement learning training method. To oversimplify it, instead of needing an ocean of expensive human-curated data and endless raw compute power to get smart, they essentially locked the AI in a digital room and had it rapidly learn through trial and error, rewarding it when it got closer to a complex reasoning goal. This drastically reduced the amount of raw compute required to achieve what we call frontier-level reasoning.
Okay, so if a company figures out how to build a world-class AI for a fraction of the cost, my initial instinct is that the market should absolutely love that. It makes the technology more accessible and more profitable. Why is that a problem?
Because it threatens the very foundation of that $150 billion CapEx spend we just talked about. This gets to the concept of the compute moat. Companies like Google and Microsoft rely on the fact that training an AI is insanely expensive. It creates a moat. It means a random startup in a garage can't compete with them because the startup can't afford a billion-dollar data center. But if DeepSeek proves that you can train a world-class model efficiently without needing a mountain of silicon, that moat evaporates. If compute becomes cheap and commoditized, the massive investments in infrastructure suddenly look like a terrible miscalculation.
Wow, that is fascinating. So the breakthrough wasn't just a technological leap, it was an existential economic threat.
Precisely. And the market understood that threat immediately. That realization caused major U.S. tech stocks to temporarily lose over $1 trillion in market value in a very short window, entirely due to fears about shifting business models.
$1 trillion.
Yeah, $1 trillion. The market suddenly wondered if it was overinvesting in the steel tracks, if someone just invented a hover train that doesn't need tracks to run.
$1 trillion in perceived value vanishes because a single technical paper suggests the underlying math of the entire industry's business model might be flawed. I mean, that is the definition of volatility. But I have to ask the multi-billion-dollar question here. Does the Stanford report actually declare whether we are in a massive valuation bubble? Do they point to these chatbot startups or the chip manufacturers and say, this is structurally overpriced?
Regarding specific pockets of value versus areas at risk of a valuation bubble, no specific data provided in the 2026 index.
Really? They just map it out and leave it to us.
Yeah. If you're hoping the Stanford researchers are going to play Oracle and pick winners and losers, they don't. They meticulously dodge that kind of definitive editorializing. They provide the raw financial metrics, the staggering compute costs, and they document the market reactions like the DeepSeek event. But they deliberately avoid declaring a financial bubble or telling investors where the specific pockets of enduring value are. They are charting the map. They aren't telling us where the treasure is buried.
Which is fair, I guess. They are researchers, not hedge fund managers. But the sheer scale of the infrastructure, build out $500 billion in corporate investment, hundreds of billions in data centers, tells us one thing for certain. These tech giants are betting their very existence that the demand for AI is going to be near infinite, which requires us to look at the other side of the equation. Massive infrastructure spending requires massive adoption to be economically viable. You don't spend $150 billion laying railroad tracks if no one wants to buy a ticket to ride the train. If Section 1 was all about the supply side, the mountains of capital and the massive data centers, Section 2 has to be the demand side. Are human beings and businesses actually using what is being built at a scale that justifies this investment?
The short answer is yes, and they are doing so at a velocity we have quite literally never witnessed in the history of human technology. Let's look at the consumer speed first. The report notes that generative AI reached nearly 53% population-level adoption within 3 years of its mass market introduction. That vastly outpaces the adoption curves of the personal computer, the smartphone, and even the internet itself.
Over half the population in 3 years. It took the internet over a decade to reach those kinds of penetration numbers. But we have to define what adoption actually means here. Like, I might adopt a stationary bike by buying it and letting it gather dust in my garage. I adopted it, but I'm not getting any cardiovascular value out of it. Do we have data indicating whether consumers are actually deriving tangible value from these tools, or are they just playing with them once and abandoning them?
That's a great point. Economists have a specific methodology for measuring that invisible value called consumer surplus.
Explain how that works.
So, consumer surplus essentially tries to measure the benefit a consumer gets above and beyond what they pay for a good or service. Since many of these AI tools are free or very low cost, researchers ask a different question. How much financial compensation would we have to pay you to willingly give up access to this tool for a year? It basically measures how much you value it in your daily life. When researchers applied this methodology to generative AI users in the US alone, the estimated consumer surplus reached $172 billion annually by early 2026.
That is a staggering metric. Even though people are largely using free tiers of chatbots, the subjective value they're getting, whether that is helping them draft difficult emails, brainstorm ideas for a side hustle, plan a family vacation, or debug some code, amounts to $172 billion a year in perceived value in the U.S. alone. That proves it isn't just a novelty. It has real economic weight for the average person. But consumer use is one thing. A college student using an AI to summarize a PDF doesn't justify a $1 trillion market cap. A Fortune 500 company fundamentally overhauling its global supply chain operations. That justifies it. What does enterprise adoption look like?
On the enterprise side, the breadth of adoption looks incredibly impressive at first glance. The survey data shows that organizational adoption across the board has reached 88%.
88%.
Yeah. And if we narrow our focus specifically to generative AI, the data indicates it is now being used in at least one business function at 70% of organizations. So the vast majority of companies can legitimately check a box saying they are using this technology.
See, I'm going to push back heavily on that because used in at least one business function is an incredibly squishy metric. That could literally mean that the 22-year-old marketing intern has a ChatGPT tab open on their browser to help them brainstorm clever tweets for the corporate account. It does not mean the AI is fundamentally wired into the core revenue-generating operations of the business.
Your skepticism is entirely warranted by the data. When we look past the top-line numbers and examine the actual depth of deployment, specifically regarding something called agentic AI, the narrative shifts dramatically.
Before you give the numbers, we need to clearly define agentic AI for the listener, because this is where the entire industry is heading.
Yeah.
Most people are familiar with conversational AI. You type a prompt into a box, and it types an answer back. It's passive. It waits for you. An AI agent, on the other hand, is a system that can be given a high-level complex goal. For example, research our top 3 competitors, analyze their pricing changes over the last year, compile the findings into a slide deck, and email it to the sales team.
Right.
The agentic system can autonomously break that goal down into individual steps, navigate different software programs, use web search tools, format data, and execute the entire task with zero human intervention along the way. It's the difference between a really smart calculator and a digital employee.
That distinction is paramount. And here's the reality check from the Stanford data. Despite the broad 88% overall AI use, actual agentic AI deployments remain firmly in the single digits across nearly all business functions.
Single digits, wow.
Yeah, when you press these organizations and ask if they have fully scaled autonomous agents running their logistics, managing their customer databases, or executing complex HR workflows, the numbers absolutely plummet.
So to synthesize this, if almost 90% of companies claim they are using AI, but actual autonomous agents are hovering down in the single digits, does that mean enterprise adoption right now is essentially a mile wide but an inch deep?
Right.
Are we just using glorified calculators instead of digital employees?
That is a highly accurate assessment of the current corporate landscape. It is a mile wide and an inch deep with one highly notable exception. When we break down the enterprise implementation of agentic AI by industry, there is a clear leader pulling away from the pack, the technology sector itself. Right. They are actively deploying these autonomous agents, specifically in software engineering at 24%, IT infrastructure at 22%, and service operations at 21%.
Well, that makes perfect sense. Software engineers are the ones building the shovels, so they are naturally the first ones to successfully figure out how to use those shovels to automate their own digging. They know how to wire these complex tools into their own workflows. But this transition from passive chatbots to active agents naturally brings us to the most vital question for anyone listening who works for a living. We know companies are buying the tools. We know some are starting to automate tasks. What is the actual return on investment? So we are transitioning now from measuring usage to measuring impact. The money is there. The adoption, at least at a shallow level, is there. But does putting an AI into a workflow actually make human beings better at their jobs? Does it make a company measurably more productive?
This brings us to what labor economists are calling the productivity paradox of the AI era. To understand it, we have to view the data through two very distinct lenses. The micro level, how the tool affects the daily output of an individual worker, and the macro level, how those individual shifts aggregate across the entire U.S. economy. Let's start with the micro gains, because in highly structured work environments where tasks are well-defined and measurable, the data shows specific, highly impressive productivity spikes.
Give us the hard numbers. What kind of spikes are we talking about?
The report synthesizes several major studies. In customer support, for instance, agents utilizing conversational AI assistants saw efficiency gains of 14% to 15%, which is measured concretely by the number of customer issues resolved per hour.
A 14 to 15% bump in resolution speed is huge for a call center's margins. What about more complex technical work?
In software development, output increased by 26%.
Wow.
Yeah, 26%. This was measured by analyzing completed pull requests when developers used tools like GitHub Copilot.
Quick definition for anyone who isn't a coder. Think of a pull request like submitting a rough draft of a chapter to an editor. It means a developer has finished writing a specific piece of code and is submitting it to be reviewed and merged into the main software project. So developers are finishing their code blocks 26% faster. What about creative fields?
That's where we see the most staggering number. Marketing teams utilizing multimodal AI, meaning tools that can generate both text and imagery for ad creation, saw their overall output per worker surge by 50%.
50% more ads created per person. 26% more code written, 15% more angry customers dealt with. Those are not marginal single-digit efficiency gains you get from buying a new coffee machine for the break room. Those are transformative numbers for a business's bottom line.
They are massive top-line numbers. But beneath the surface of those averages, a fascinating and complex dynamic is occurring, which the researchers term the leveling effect. These productivity gains are not distributed evenly across the workforce. The data consistently reveals that less experienced junior workers are the ones gaining the absolute most from AI assistance.
How much more?
Well, going back to the customer support example, newer, less skilled agents saw massive performance gains of 30% to 35% when assisted by AI.
Wait, up to 35%.
Exactly. The AI essentially acts as an instant equalizer. It lifts the bottom performers up, allowing them to operate at the level of an average or even a top performer almost immediately.
From management's perspective, that sounds like a dream scenario. You hire a junior worker, you pay them a junior salary, but on day one, the AI elevates their output to the level of a seasoned veteran. But what happens to the actual seasoned veterans? If the AI lists the floor for the juniors, what does it do to the ceiling for the seniors?
That is exactly where the paradox deepens. For highly experienced senior workers executing complex tasks, these tools are not always a silver bullet. In fact, they can sometimes be a severe hindrance. The index highlights a highly cited study from an organization called METR, which examined highly experienced open source software developers. This study found that these senior developers actually became 19% slower at their tasks when they were forced to use AI assistance.
Wait, they got 19% slower. How is that possible if the AI writes code instantly?
It comes down to the nature of complex problem solving. There was a significant gap between how helpful the developers perceived the tools to be and their actual timed performance. The AI was exceptionally good at outputting code that looked highly plausible on the surface, but because the tasks were highly complex, the AI introduced subtle, systemic bugs. The senior developers spent significantly more time hunting down and debugging these hallucinated errors than they would have spent just writing the code from scratch themselves.
Oh, that makes perfect sense. It's the phenomenon of plausible BS. If I ask an AI to write a basic essay, it's fine. If I ask it to write a highly technical legal brief, it might invent a case law that looks completely real. A junior lawyer might not catch it, but the senior partner will have to spend 3 hours verifying a citation that doesn't exist. So the tool acts as a floor for the juniors, but a ceiling and sometimes a trap for the seniors.
Exactly.
But let's think about the long-term implication of this for the junior worker. If that junior support agent is relying on the AI to give them the answers and hit those 30% gains, do they ever actually learn the underlying mechanics of their job?
You've just articulated perhaps the most concerning long-term finding in this section of the report: the productivity versus skill losses dilemma. Researchers set up an experiment looking at software engineers who were tasked with learning entirely new code libraries. The engineers who relied heavily on AI to learn those new libraries showed absolutely no measurable speed improvement over time. The researchers explicitly state they suffered from learning penalties, raising profound concerns about long-term technical skill retention.
Let's use an analogy here because this is crucial. It's like using a GPS. Think about it. Before we had smartphones, if you moved to a new city, you had to physically learn the grid. You got lost, you took wrong turns, you memorized landmarks, but eventually your brain built a robust cognitive map of the city. Now, you use a GPS. We get to our destination 26% faster today. But over time, we completely lose our innate sense of direction. If your phone battery dies, you have absolutely no idea where you are or how to get home because you never built the internal map. Are we trading long-term human capital and skill retention for a short-term sugar rush in corporate output?
The GPS analogy perfectly encapsulates the danger because it highlights the critical difference between executing a task and fundamentally understanding a system. The data strongly suggests we are prioritizing immediate execution speed over deep system comprehension. And what's fascinating is how that micro-level individual dynamic is aggregating into what we are seeing at the macro level of the broader economy.
Okay, so what does the macro level look like?
At the macroeconomic level, the U.S. economy saw a productivity growth rate of 2.7% in 2025. While that single-digit number might sound small, in macroeconomic terms, it is massive. It is nearly double the previous decade's average productivity growth of 1.4%.
Doubling the national productivity growth rate is monumental. Is the economic consensus that this is all directly attributable to AI adoption?
It's notoriously difficult for economists to isolate a single variable in an economy as complex as the United States. But researchers point to a concept called the J-curve hypothesis to explain how AI is working its way through the system. Think of the shape of the letter J. The hypothesis suggests that organizations initially have to absorb heavy adoption costs. They spend billions buying the software, redesigning their workflows, and attempting to train their staff.
Right.
During this installation phase, productivity might actually dip or remain entirely flat. That's the downward hook of the J. But companies endure this, hoping for massive exponential aggregate gains later. Once the technology is fully integrated, that's the long upward sweep of the J. The 2.7% growth suggests the U.S. economy might finally be starting to move up the right side of that curve.
So to summarize the productivity picture, businesses are absorbing massive costs now, and they are seeing incredible output gains in highly structured tasks, particularly from their junior staff. But they are achieving this at the very real risk of those junior staff never actually mastering the underlying cognitive skills of their profession. Which brings us to the inevitable consequence of that dynamic: If AI is artificially boosting the productivity of juniors while simultaneously harming their long-term skill development, how is that impacting hiring decisions today? We need to shift our focus from how people work to who actually gets hired. And this is where the data gets incredibly real and frankly terrifying for anyone currently in high school or college preparing to enter the job market.
Yeah, the data reveals a stark, deeply consequential trend that labor researchers are officially categorizing as seniority-biased technological change. Simply put, organizations are utilizing AI as a direct substitute for junior-level human labor.
A direct substitute.
Yes. The most visceral, measurable example of this is happening in software engineering, which makes sense, as that field has been the tip of the spear for AI adoption. According to the data, employment for software developers ages 22 to 25 fell by nearly 20% from 2024. And if we look further back, it's down close to 20% from its absolute peak in 2022.
A 20% drop in employment for entry-level developers. I mean, that is a crater in the labor market. That represents an entire graduating class of computer science majors who did everything right, got their degrees, and are now finding the door slammed in their face. Is the entire tech industry contracting, or is this pain isolated to the youth?
It is intensely isolated to the entry level. The report explicitly notes that even as the headcount for those 22 to 25-year-old developers plummeted by nearly 20%, the headcount for older, mid-career developers actually continued to grow. Organizations are aggressively hoarding senior talent while simultaneously shedding junior talent.
Wait, let's connect the dots here, because on the surface, this feels like a massive contradiction. We just spent the last 10 minutes discussing data that proves junior workers get the biggest productivity boost from AI, up to 35% gains. The AI makes them immensely more valuable. If they are the ones benefiting the most from the tool, why on earth are companies hiring almost 20% fewer of them? Are organizations deciding it's cheaper to have an AI do junior-level work rather than hiring actual juniors and upskilling them with AI?
That is precisely the cold economic calculus the data suggests is happening in boardrooms. We have to remember that jobs are essentially just bundles of tasks. If a senior developer, utilizing a powerful AI agent, can now autonomously generate boilerplate code, run basic quality assurance tests, and draft system documentation tasks that traditionally constituted the entire workload of an entry-level junior developer, the company no longer needs to hire that junior developer.
Oh, I see.
The AI hasn't automated the entire complex job of a senior systems engineer, but it has completely automated the rudimentary tasks that used to make up an entry-level position.
The entry-level job is being eaten from the bottom up. The senior person absorbs the AI, and the junior person gets eliminated. So, if companies aren't hiring young people for basic implementation and coding, what are they actively looking for? What does the labor market actually demand right now?
The labor market is aggressively pivoting away from execution and moving toward infrastructure scaling and orchestration. They desperately need people who understand how to build, manage, and secure these massive AI systems at an enterprise level. We can see this shift vividly in the job posting data analyzed in the report. The specific technical skills requested in job postings tell a very clear story about where the market is heading. Python, which is the foundational programming language for almost all AI development, appeared 258,674 times in job posts.
That's a lot of postings.
Yeah, that represents a massive 391% increase.
Okay, an explosion in demand for Python makes perfect sense. It's the lingua franca of the AI revolution. What other skills are surging?
Skills explicitly related to scalability are up an astonishing 733%, appearing in 197,744 job postings. Workflow management is up 818%, reaching 186,325 postings.
818%.
Yes. Furthermore, if we look specifically at the micro trends within AI skills, the demand is moving rapidly away from basic familiarity. Postings asking for someone who knows how to use ChatGPT or write basic prompts are actively declining. Instead, the explosive demand is for engineers who understand agentic systems and specific orchestration frameworks like LangGraph.
Let's define LangGraph quickly for the audience. It's basically a framework that allows developers to build complex multi-actor AI agent systems. It's what allows you to have 3 different AI agents talking to each other to solve a single problem without a human in the middle. The key word you use there is orchestration. That is a fascinating shift in how we think about work. It implies that the human job isn't playing the instrument anymore. The human job is conducting the orchestra.
That's a great way to put it.
The AI agents are the violinists and the cellists playing the actual notes, and the human is the conductor standing on the podium, making sure they all play in the correct time signature and don't completely derail the performance.
That is an incredibly accurate way to conceptualize the modern senior workflow. Employers are hunting for architects. They want systems thinkers who understand how to deploy a swarm of AI agents to solve a complex, multifaceted enterprise problem at immense scale. They have zero interest in hiring someone whose only skill is writing a clever text prompt. Now, I do want to make one thing clear about the data here.
Sure.
Regarding the explicit demand for Sokoko, test management, and architecture versus junior-level implementation, no specific data provided in the 2026
Oh,
index.
really?
Yeah, the index doesn't provide explicit granular numbers breaking down the demand for specific subdisciplines like traditional software quality assurance versus junior-level implementation. But the overwhelming surge in demand for scalability and workflow management strongly infers that systemic architectural thinking is what the market values above all else right now.
So we have a deeply unstable situation forming. Companies desperately want senior-level systems architects who can orchestrate these massive AI deployments, and simultaneously they're completely abandoning the hiring of the entry-level junior implementers. The structural integrity of that labor pipeline seems incredibly fragile, and that fragility brings us to the blind spots, the things we cannot see. Hashtag strategic risks and labor market bottlenecks. Up until this point in our investigation, we've talked exclusively about the signal we can clearly see in our corkboard. We've mapped the billions of dollars invested, the staggering productivity bumps in specific sectors, and the vanishing youth jobs in tech. But all the data we've discussed so far points to an economy in a highly volatile, highly disruptive transition period. Now, we need to look closely at the shadows on the board. We need to examine the blind spots, the missing data, and the explicit catastrophic risks to the labor market that the Stanford researchers are warning us about.
And those warnings are incredibly stark, particularly when we examine what corporate employers are anticipating for the immediate future. The survey data reveals that a full 33% of organizations expect AI to directly reduce their total workforce size in the coming year.
Wait, one-third.
Yep, 33%, and that figure climbs even higher to 35% when you look exclusively at large organizations, the massive enterprise companies with over $1 billion in annual revenue.
Let's not gloss over that. A third of all companies and more than a third of the massive multinational corporations that employ millions of people globally are actively forecasting headcount reductions next year due to AI. That isn't a speculative theoretical risk. That is a massive wave currently forming on the horizon. Where exactly is that wave going to crash?
The anticipated job losses are expected to be felt across nearly all business functions, but the data indicates they will be especially acute in service operations, supply chain logistics, marketing, and software engineering. What is particularly alarming to labor economists is the expected pacing of this displacement. The survey data shows that the expected decrease in headcount for the coming year significantly outpaces the actual decreases organizations observed over the previous year.
Meaning the bloodletting is speeding up.
Precisely. Employers firmly believe the pace of job displacement is going to accelerate rapidly. And as we discussed in the last section, early career workers in highly AI-exposed technical fields have already seen a 15% to 16% drop in employment. That isn't a forward-looking forecast. That is historical recorded fact. The displacement has already begun.
If a third of massive companies are forecasting headcount reductions next year, and labs are hiding the actual scale and power requirements of these models, well, actually, wait, let me back up. If we have a 15 to 16% cratering of youth employment in exposed tech sectors, how can policymakers or workers prepare?
That question leads us directly into what is arguably the most critical strategic risk identified in the entire report: the missing data bottleneck. In economics, there is a fundamental rule. You cannot manage what you cannot measure. And right now, at the macroeconomic and systemic level, we are rapidly losing our ability to measure the AI ecosystem.
Explain that to me. We just spent an hour dissecting incredibly granular data from a 400-page academic report. We have numbers on investment, productivity, and hiring. How can we possibly be losing our ability to measure what is happening?
Because the fundamental nature of what is being shared by the most powerful corporate actors is changing, and the transparency is vanishing. First, as we noted earlier, while we have that 2.7% U.S. productivity number, isolating macro-level productivity gains and tying them conclusively to AI deployment across thousands of different industries remains incredibly complex and mixed.
Right.
But far more worryingly, the frontier AI labs, the handful of multi-billion-dollar companies actually building the most capable foundational models, are actively, purposefully reducing transparency.
Give me an example of how they are hiding the ball.
Go back just a few years. In the past, when a major tech company released a breakthrough AI model, they published a rigorously detailed technical paper alongside it. They told the scientific community exactly how many parameters the model had, meaning how complex its neural network was. They detailed the specific data sets it was trained on, exactly how much raw compute power was used, and exactly how long the training process took. Today, that critical information is increasingly withheld from the public domain.
Why this sudden secrecy?
Well, the labs claim it is primarily for competitive advantage, protecting their massive investments, or they claim it is for safety reasons, arguing that publishing the blueprints for a highly capable AI could allow malicious actors to misuse it. Regardless of their stated intent, the result is that independent academic researchers, government auditors, and the public are flying completely blind. This opacity severely cripples our ability to conduct independent safety benchmarking and risk assessment.
So the complex, uninterpretable black box of the algorithm itself is now wrapped tightly inside a second black box of corporate secrecy. We just have to take their word that it's safe.
That is exactly the situation, and this lack of transparency extends far beyond software safety and bleeds directly into the physical world. The massive environmental and infrastructure bottlenecks being created by these companies are also being actively obscured. For example, essential power draw information, how much electricity these massive data centers are actually pulling from the grid, is simply unavailable for many of the newest foundational models released.
Wait, we know they're spending $150 billion on data centers, but we don't know how much power they are sucking out of our local communities to run them.
Correct. We have isolated data points that hint at the scale. For instance, we know that the estimated training emissions for a single model like Grok 4 reached over 72,000 tons of CO2 equivalent.
72,000 tons of CO2
Yeah.
for one model.
Yes.
That is the equivalent emissions of tens of thousands of gasoline-powered cars driving for a year just to train a piece of software.
And that is just one model we happen to have data on. For many of the leading models driving this entire economic boom, we simply do not know their true energetic cost. We don't know the exact strain they are placing on the national power grid, and we don't know the volume of water usage required to cool their massive data centers.
Let me try to synthesize the absolute anxiety of the situation for the listener. If a third of massive companies are forecasting headcount reductions next year, and labs are hiding the actual scale and power requirements of these models, how can policymakers or workers prepare? Are we flying entirely blind into the biggest labor disruption since the Industrial Revolution?
The data presented in the Stanford Index strongly, empirically suggests that we are entering a period of profound structural adjustment with incredibly poor visibility. The financial incentives driving these companies are pushing them toward rapid, unchecked deployment and massive scaling, while the measurement, safety, and governance frameworks meant to protect the public are lagging dangerously behind. Hashtag outro.
We have covered a truly massive amount of ground today on our investigative corkboard. We follow the red string from the $581.69 billion of global corporate investment, noting the staggering dominance of the U.S. private market and uncovering the hidden depths of Chinese state funding. We explored how those hundreds of billions are building a colossal physical infrastructure of data centers and silicon chips, and how breakthroughs like DeepSeek R1 threaten the very economics of that infrastructure.
We then traced how that infrastructure is powering unprecedented consumer surplus and enterprise adoption, leading to real, measurable micro-productivity gains, the 26% faster coding speeds, the 50% boost in marketing output. We explored the J-curve of macroeconomic growth that suggests we are just beginning to see the true impact on national GDP.
But we also followed the string to the dark side of the board. We examined how those productivity gains are fundamentally, perhaps permanently, altering the labor market. We saw the data showing organizations freezing out entry-level tech workers by nearly 20%, substituting junior labor for AI agents, and actively threatening the long-term cognitive skill development of the human workforce. And we end on the stark, sobering reality that we are facing this monumental transition with less transparency, less corporate cooperation, and less hard data than we had even 2 years ago.
Yeah, the undeniable signal within all of this noise is clear. AI is no longer a future speculative technology relegated to sci-fi novels. It is a current, aggressive macroeconomic force that is reorganizing capital, compute power, and human labor right now, today.
Which brings me to a final provocative thought for you to mull over as you go about your week. We look closely at the data showing that junior roles are vanishing, but the demand for orchestrating massive AI systems is exploding. Think about what that actually means structurally. It means the ladder to senior expertise is fundamentally broken. Think about your own industry right now, whether you are in law, finance, medicine, accounting, or construction. If the entry-level work, the tedious, repetitive, foundational task where you actually learn the mechanics of your trade, if that is automated completely tomorrow, how will your specific field train the senior experts of 2036? What does mentorship actually look like when your apprentice is an algorithm?
It is a profound, systemic, structural problem that every single industry will have to solve, and they will have to solve it quickly, or risk a massive shortage of human competence in the next decade.
It is more than enough to keep you up at night. But staying deeply informed, looking past the corporate marketing hype, and tracing the actual data-backed connections is the absolute best way to navigate the noise. Keep looking at the corkboard, keep questioning the narrative, and keep following the red string. Thank you for taking this deep dive into the source material with us today.